Hey, it's Josh Lewis with Bywise Mortgage back, and you're going to notice another face here on the screen. Many of you know him, some of you don't. Scott is my business partner in Bywise Mortgage. Scott Schang is also the founder and business partner with me in Find My Way Home in 2007. He created that resource, and it's been through many iterations through the years. He and I partnered up because of our joint commitment to what he had titled as part of Find My Way Home's mission to educate and empower homeowners and borrowers throughout this process. So what we wanted to do is just bring him into the conversation, and probably about once a week, one of these updates, really talk about the things. We have really interesting conversations, or at least for me, a mortgage guy, that I think are interesting in our office about things that are coming across our desk, things that we're seeing, issues, problems. Scott has a really interesting window into the world in Find My Way Home because a lot of people find us there because they have problems and they reach out to Scott. So tonight we are really going to focus on interest rates. If you've listened very long, I've probably said this more than once. Interest rate is probably the least important thing in your mortgage transaction, largely because in the internet age, most everyone is in a fairly narrow range. I like to think and believe and know that we are on the low end of that price range, but there's lenders that come in lower on the price spectrum. But again, lenders are going to be within a fairly narrow range. But right now, where we're seeing like 4 of the last 5 weeks, we've seen the headline on Friday, hey, mortgage rates hit an all-time low. So we're going to go into that, talk about it a little bit tonight, what it means and what you need to be aware of in terms of interest rates. So you know, Scott, Scott, I know Scott's been watching, and those of us that follow, we go into where are interest rates, where are they moving, what's going to happen. Tonight, we want to talk about what you're seeing in mass advertising.
Yeah, exactly. I mean, one of the things that always happens when rates drop like this is the vultures start to circle. I don't really know a better way to say it, but you really start to get this sort of, oh man, it's sort of a predatory force of these telemarketing call center lenders that are set up specifically to do refinances. And there's a couple of really huge challenges that come with this that we've seen for years, Josh, is that a lot of these people are just getting hired to answer phones and read a script. They're not real loan officers. They're just trying to slam deals. Another thing that happens, and I'm not going to throw you completely under the bus, but I know you had a front row seat. You used to run Consumer Direct at a very large lender, and you used to do mailers. We're seeing a lot of those today. Why don't you give us some insight on what that really is?
We would do 300,000-400,000 pieces of mail a month. And most people don't realize what that is. We all of the time get questions. Myself, my loan partner, Russ, we get the question, hey, I just got like 4 things in my mailbox saying I can get a rate of 2.5 with no cost. And you're like, okay, well, let's talk about what that is. That's kind of the question that you're asking. How does that mailer end up in your mailbox? Data for those mailers can be either really cheap, even free. A lender can call up a title company and say, give me all homeowners in this area. And they're going to send them a disc that has the addresses on it. That's the cheap to /free list. All the way to the high end of really expensive data saying, I want borrowers with a specific type of loan that bought within a time frame that have X credit score, or maybe they drive this kind of car. So that's the type of data they have. They know credit score ranges. They don't know your credit score. They don't know your home value. They kind of have.
But they know that you're a homeowner.
They know you're a homeowner for the most part, but even renters will occasionally get one that's wrong. So from looking at that perspective, what you're seeing there is usually fairly low end data, but it could be high end data. A lot of times, like if they know you have a VA loan, you're a veteran, you have a VA loan, it's a little bit better, but they know nothing about you. And when they know nothing about you, they also know that if they put the middle of the road term that they know most people or everyone would qualify for, they're not going to get a lot of inquiries. Their goal is to make the phone ring. So the number that they put on there, in the best of circumstances, is what the perfect borrower could get. In most circumstances, it's what no borrower could get, because they're trying to make their phones ring, and they know that they can disqualify you. Hey, your loan amount's not high enough. Hey, your credit score is not good enough. Hey, you don't have quite enough income for that interest rate. So really just know that all those mailers are for is to generate inbound phone calls to a large call center, which those call center staffs are not your expert, experienced loan officer. Scott and I, you and I have talked. The getting the best loan officer is more important than getting the best interest rate, unless otherwise we're saying, you're so well qualified that you can go anywhere and get a loan, and even the 22-year-old doing his first loan can figure that out.
Yeah. So are there any other red flags? Because I know back in the day, I haven't heard a lot of it recently, but a lot of these refi shops that would do that kind of, and I'm going to call it misleading, because it's vague information. It is not an offer of credit to you specifically. It's just a number that they're throwing up there. I know a lot of those call centers used to ask for credit cards on that first call in order to order the appraisal. Is that something that's still happening? Is that maybe a red flag that people can look out for, that they're not giving you time to understand your options or discover anything? They're going straight for the numbers?
There's a couple things. The big one used to be they wanted to get your social security number to run your credit, because people didn't want 50 people running their credit. So the first person to pull the credit, then get them to give you a credit card so you can order and charge an appraisal. And as soon as that goes through, then they're not going to want to go to another lender. Anyone wanting to, I have sort of a balance of this, of saying, no, I don't need to charge a credit card up front. We need to get all the way into the process before the disclosures go out, before we're doing anything along those lines. But what I will say is, the more information we have, the more accurate info we can get. The best example I have, a lady came in. We use a system called HomeBot, and we sponsor a lot of realtors, and their clients get our HomeBot reports in there. So one of our realtors' clients, who I'd never spoken with, she contacted us off of that and said, hey, we own our home free and clear. I want to take some money out from that property and buy a new one. I said, well, cool. Well, we have a couple of things here that are kind of important. Can we get some basic information so that I can get you accurate information? She's like, I don't want to do anything. My credit score is perfect. It's 800. Can you just give me numbers? The more information that we have, the more accurate information we can give you. Credit score is an important element of that. And for her, that situation and where they were in the process, it probably is enough. And it probably does make sense. We don't need to push for more information.
But you know that because you're a professional. And the challenge that I think we run into, and the feedback that we get mostly is that they're talking to somebody that isn't, an interest rate isn't always the reason to refinance your loan. If you're in a 20-year, if you've been paying your loan for 10 years and you get a little bit lower interest rate and you stretch it back out to 30 years, and somebody doesn't explain that to you, then you're not making an informed decision. And that's really the thing that worries me the most when rates drop like this, and those vultures come out, is that they're just slam bam, thank you ma'am. They want to get through the calls, they want to get you logged, they want the check mark on their application on their call sheet, and they're just moving on to the next. But they're not having conversations with you about what is the best financial decision for you and your family, and structuring it in such a way that you're going to benefit over the long term.
Absolutely. That example that you gave, a borrower sent in a mortgage statement yesterday, said, hey, it's not a big loan. So their loan, I think, was $174,000. Doesn't take much movement on a $500,000 loan for it to make sense. They said, hey, we have not a good rate, but not a terrible rate. It's 4.125. We know it's higher than where the market is, but everyone we call just says, yeah, we can get you a lower rate. And then we look at it and we're like, I don't want to give up 4.5 years of payments to save $75 a month. So we ran through the numbers, and it really is an analysis that someone needs to be able to lay out on paper for you. For them, we came down to one of two conclusions. We can do a custom term and keep the loan where it was 25 and a half years left, and that would have saved them about $65 a month. And a reasonable person could conclude, hey, it's kind of a pain in the butt to do a loan. Maybe $65 a month isn't worth it to me. We ran through it the other way and said, hey, if we roll this down to a 20-year, payment's going to go up $70 a month, but we're cutting 5.5 years off of that. And they're getting near retirement age. It's a vacation home. And with that, they're like, yeah, let's do that. We can get this thing paid off and leave another asset to our children, a part of our financial legacy to our kids. So that's really what you're not getting in a call center. And for the most part, like what I want to say is, I will always tell people, you pull 100 lenders, we're much closer to the cheapest than we are to the most expensive. But for the most part, we're always cheaper than the big call centers that you're seeing on TV, that you're seeing on radio, because they don't have a lower cost structure. They're paying those inexperienced loan officers less, but they're spending a ton of money on marketing. If you've noticed, the biggest lender in the country that you hear 10 of their ads or see or watch them every day, they never talk about the best terms because they don't have the best terms. They're not even close. Now, I can say that. I also know a guy here in town that has a call center, and they have the absolute lowest rates in the world. Like, I would not want to take a bet that I could go find a lower rate than him. Now, I also know that almost any loan officer in the world is going to have more experience and more knowledge than his loan officers, but they don't tell you that they're the best. They tell you that they're the cheapest. They have a good system that will get it through efficiently. So just a long way of saying it's a balance there of what we're looking for. I think most people want to get close to the cheapest loan, but realizing there's a trade-off in that. No one wants an expensive loan. No one even wants middle of the road. We should be towards the lower cost end of the spectrum, but you don't want to sacrifice advice and expertise, because talking about with Find My Way Home, all of the inquiries that we get of people who have been misled, lied to, just told inaccurate information by inexperienced people. Now, like I had this conversation with a borrower today, and they owed $200,000 on an $800,000 property. They had an 800 credit score. They had one pay stub and a W-2, and we had an appraisal waiver. It's the easiest loan in the world. A loan officer doing his first loan could do this loan. So if she wants to shop the universe and find the cheapest lender in the world, there's almost no risk there. Anyone could do it. But for most of our borrowers with a little bit of hair on them, I got another guy came in today, 800 credit score, couple $1 million in the bank, and he has 6 properties. He wants to refinance them all. We also have 3 business tax returns and a Schedule E with 7 properties on it. Good luck going to a call center with that. Financially, they're equivalent borrowers, but one's really easy for a loan officer, one's really hard. So looking at those two, it's just, I would definitely, you want to get excellent terms, but we also want to validate and value experience and expertise, depending on how complex your situation is.
Yeah, and we say this all the time, and I see this over and over again. It's a lot of the times it's not that those lenders are lying to you, it's that they're just answering the question that you asked. And if you're not asking the right question, they're not going to understand what it is that you're really talking about, and they're just trained to say yes. And just like your scenario with your $65 and making that comparison, and I know from our experience that there's a lot of times we have conversations and we end up saying, maybe this isn't a good time. Maybe you're in good shape. Maybe you should just try this strategy, pay a little bit extra and pay it off sooner or something. There's all kinds of scenarios, but I think this is a really important conversation that we need to have, and we're probably going to be having this conversation because it sounds like there was some movement with interest rates that you were talking about, and you've been talking a couple of weeks about this spread between where rates should be and where rates are. And I think you were telling me yesterday that we're starting to close that gap a little bit and maybe starting to be able to see out a little bit that potentially interest rates are going to be good for a while.
Rates, well, the Fed yesterday finished their we have 10 meetings a year, so not quite a monthly meeting. But the Federal Reserve president comes out and says, we're not even thinking about thinking about higher interest rates. So that's part of the reason why you saw stock struggle yesterday, stock struggle today. They had some pretty pessimistic expectations for GDP this year and next year, really low expectations for inflation, and expecting to keep rates low for the foreseeable future. So with that, for us in the mortgage business, absolute interest rates, so treasury rates, and then also the rates on mortgage-backed securities. When a lender pools all their loans together and sells them on Wall Street, the prices that they're getting, so the yields on those are at all-time lows and have been. But the spread between those yields and what they're charging borrowers has kind of been not at an all-time high, but at a high going back 12 years to 2008. At 2008, the spread between the 10-year treasury and 30-year fixed rates had got all the way up just over 3%. When all of the forbearance stuff and coronavirus and unemployment figures hit, that spiked up to a little over 2.7%. I need to check in because I think we should have seen today when Freddie Mac puts their numbers out, we can look at where that spread is right now. Last week was about 2.44. So we're down to that 2.4 range. But putting that in perspective, historically, the high end is about 2%. So other things being equal, treasuries and mortgage bond prices stay where they're at right now. We still have about 0.4% that we could move lower in interest rates. So what's really important, like talking about that discussion, we have clients last week that were in a panic because we had a really strong ADP jobs report and then a really strong Bureau of Labor Statistics job report Wednesday and Friday of last week. So rates had spiked up. We've kind of moved out of the trading range that we had been, and everyone's like, lock my loan, lock my loan, lock my loan. Well, now everyone this week was, wait, they're a bunch better. The Fed came out and said they're going to be low. And at the grand scheme of things, there wasn't a huge difference. But this is what happens when someone goes, well, I locked with that guy last Thursday because I thought they were going higher. And now there's something in my mailbox that says, hey, call this guy and he can do lower. It's a tough one. I understand from a consumer's perspective that they want to get the absolute best and lowest interest rate, but realize that when you ask someone to lock in an interest rate for you, they are committing to delivering that, even if rates go up 0.5%. So you walking out and saying, well, Joe down the street didn't lock me and he can get me 1/8% lower. You got to think about, is that the right thing to do? You bought insurance and then you don't want to pay for it.
Yeah. No, that's a tough conversation. I don't know if a lot of consumers understand how that works. But if you have a good relationship with somebody like you, you're always going to do the right thing, and you're going to have a conversation with them. And if it's 1/8%, if it's something really close, have a conversation with your lender. You don't want to bail because you see a blue light special down around the corner, or you get something in the direct mail, something like that. Hopefully you find somebody like Josh that you can tell, talking to him, this is a guy that understands this isn't looking out for my best interest, and always have that conversation, and you'll always look out for their best interest. So go ahead.
Yeah, I was going to say, and at the end of the day, we're talking about interest rates and the levels of interest rates. They're really low. We're at an all-time low. So the thing that I keep wanting to leave people with, I hear people who can benefit from today's interest rates saying, you know what, I'm going to wait and see if they go lower. Yeah. And you go, okay, rates are at the lowest they've ever been. Mortgage rates, the lowest they've ever been in the United States of America. And there is a reasonable savings for you to have here. But you want to wait and see if they go even lower. If they go lower, how much lower can they go? So all I'm saying with that is I wouldn't be paying points. We have lenders, the big telemortgagers are pushing, saying, well, hey, rates are at an all-time low. If you pay 2 points, we can get a low. Well, you're trading, a couple points of your equity for a super low interest rate that we may get for free in the future. So I think it's a reasonable thought that rates may go lower, but we have no guarantee of that. It's a 50-50 proposition at best. If you are at a rate that the numbers justify doing a low or no cost loan today, I would by all means investigate that and pursue it. And then 6, 12, 18 months, if this stretches on and rates move lower, you haven't traded a bunch of your equity, you don't have a bunch of sunk costs in that loan, you can do it again. Because really right now, it's very hard for anyone to say what happens with interest rates going forward. Right. One of the guys I love following is John Malden. Every year, John Malden does his strategic investment conference, brings in literally the smartest people around the world, and they get up on stage and they say, this is what I think is going to happen. And this year he had about 5 guys who thought that 10-year treasuries would go to 0.3 to 0. So that would give us easily interest rates at 2.25%. Also, 5 equally smart guys on stage saying this is going to trigger inflation and we're going to have treasuries back at 1.5%, 2% in the near future. So really smart people can disagree about this. It's hard to say what's happening from day to day. We look at the technicals, we look at the funny little candlesticks that I like to show here, and we make our best decision. And what I like to tell people is the technical analysis is sort of like counting cards in blackjack. It doesn't guarantee you're going to win the next hand. It tells you when to bet more heavily because the odds are in your favor. So that's kind of where we're at. You know, you and I have run here long, like 20 minutes. So like I said, we're going to continue this conversation. I'll probably do sort of a weekly update with just some basic stuff on Monday nights. And then Thursday, we'll come back here and recap. Like I said, we have interesting conversations, interesting stuff pops across my desk in terms of loan files, things that Scott's seeing in terms of questions that people are asking on the website. And it's good information we'd love to share with you.
And you know, one thing that we always talk about on Find My Way Home, the reason we do these kinds of things, the reason we do this and we have these conversations is because we want consumers and homeowners to know how professionals talk, how they communicate when you're not trying to be sold something. Because anytime you pick up the phone and you're trying to do business with a lender, they're always trying to get you to do business. They're telling you what you want to hear, and they're trying to tell you. So we're hoping that being able to have these conversations sort of anonymously, we don't know who's watching or what they're paying attention to, but now you have sort of this foundation as contrast for if you end up getting on the phone with somebody that doesn't know what they're talking about. You're going to think back to what Josh was talking about, and you're going to be like, well, maybe that wasn't the way to go.
And you know, one of the things that I always like to say, Scott, when you're talking, that's magic. You flipped around. Now I can read your Home Sweet Home over your shoulder.
I'm using this is actually really cool. I'm using my iPhone as a webcam, and a phone call just came in and it froze, and I was like, cool, that's my opportunity I forgot to flip it so you could read my little
I thought you jumped up and twisted around. But what I was going to say to close this is numbers never lie. People sometimes do. I don't want to say people always do because they don't, but people can try to mislead you. Ask for it in writing. Look at the numbers. Look at a comparison. You know, people can give you incorrect numbers or not follow through on the numbers that they deliver, but they should be able to provide them to you in a written format and walk you through them in a way that you can understand. So again, we only do loans here in California. There's 49 other states in the union. The internet is worldwide. So if you're watching this outside of California, we have a big network of folks we can connect you with. If you're in California, I always love to have these conversations, and I am more than happy to review numbers. And I don't ever want to steal a loan from someone who's doing a good deal for you. If you just want some peace of mind and say, hey, here's my loan estimate. Does this look reasonable? Does this look right? Yeah, it does. Or no, you're paying too much for that loan. Or hey, there's a better option for it. So don't ever feel bad about getting a second opinion. Respect the person that's doing a good job for you and giving you accurate information. If you get a second opinion and the second guy wants to come in and say, hey, I can do it for $400 cheaper. Again, respect the relationship and the time and the effort the first person gave you. If it's $4,000 lower, you're probably going to go with the guy that's $4,000 lower, no matter how nice and wonderful the first person was.
Yep.
So,
excellent.
All right, we will be back. Thanks for joining us, Scott. We'll be back next week. If you have any questions for either of us, reach out. You can post messages and questions here, or just check in next Monday and Thursday and let us know what we can do for you. All right. Have a good week.
Bye.